Who would say no to free money, right? Especially when that is exactly what we look for as investors, to get our money back. And that is basically a valid way you could describe dividends. Just free money the business gives you in return for being a shareholder. But in reality, it's not as good as it sounds. And sometimes, the fact that a business is paying a dividend is actually a reason for you to stay out of it. Dividends are a fraction of the company's profits that is paid to shareholders as a compensation. So it's basically a courtesy payment for being a part owner of that business. These payments are received periodically during the year, and the frequency depends on each business. Some companies like Coca-Cola pay dividends on a quarterly basis. A few others like Realty Income pay it on a monthly basis, and some others just once a year. But every quarter is the most commonly used. If you want to receive the dividend payment, you need to make sure you're holding the stock before the ex-dividend date. This is kind of a deadline on the accounting records of the business to determine which investors will start receiving dividend payments from the next period. And only those who owned the stock before the market closed on the previous day to the ex-dividend date as a maximum will receive the next dividend, and all others will only start receiving it on the upcoming period. Companies like Coca-Cola or Johnson & Johnson are described as dividend kings. A dividend king is a company among the 500 biggest companies in the US, mostly blue chips, that have been paying out and constantly increasing their dividends for the last 50 years or more. And here you can see part of Coca-Cola historical dividend payments and how they have increased over time. There are also companies called Dividend Aristocrats, which are also part of the S&P 500 and have been paying and increasing their dividends for 25 years or more. Examples of these could be Caterpillar or AT&T. When I invest in a business, I really like to take the time to see if they're paying a dividend and how much they're paying, but not exactly because of the benefit that I will get from it, but because of the red flags that I can identify by reviewing it, as well as some other companies that just the fact they're paying a dividend is a red flag itself. So before we get into the dark side of dividends, it is worth mentioning that companies are not obligated to pay them, and if they're paying one, they're free to cut them off at any time. However, even though they're not obligated, this doesn't keep investors from reacting whenever their dividends are cut. Let's take some real-life examples such as Barnes & Noble, which is one of the biggest bookshops in the United States. They had been paying a constant dividend for several years, which was actually increased by 40% in 2008. Just about a year after Amazon was releasing their Kindle ebook reader, representing of course a potential competitor for them. 3 years later, they announced they were going to cut off their dividends. They wanted to focus instead on reinvesting this money into the business to expand their services in the digital world and get ahead of Amazon. And maybe this wasn't actually a bad idea, maybe their stock would have really benefited from this. Unfortunately, the stock reductions or suspensions are not taken that way by investors. Here you can see how their stock plunged in 2011 right after they announced this. Same thing happened to General Motors, which is a giant, back in 2008. They stopped paying a dividend after they had been paying a very modest 10% dividend yield, and soon after they declared bankruptcy. But wait, what is a dividend yield? This is a metric that helps you know what percentage is being paid out as a dividend relative to the business share price. For example, if a business is trading at $100 and pays $10 as dividend per share each year, their dividend yield will be 10%. You get the dividend yield by dividing the dividend paid with the stock price by 100. Because the stock price constantly fluctuates during the day, the dividend yield will also fluctuate. So if the same stock worth $100 closes the day at $90, the 10% dividend will now represent a higher percentage. Just like the stock can increase to, let's say, $110, and the dividend yield will be smaller. Usually, a 4 to 5% dividend yield is still considered okay, but you have to be real careful with dividend yields higher than that. Now, you might be wondering why. I mean, after all, a high dividend yield could mean you're getting more money in some cases, but that is exactly the problem. A big dividend payout could be perceived as a mismanagement of resources. because they could be reinvesting a big part of that money into the business to promote the stock price instead of just giving it away. Also, if a company pays a lot of dividends, they might be vulnerable in the future if sales decrease or an unexpected event takes place that might force them to cut them off, or even worse, incur into debt to be able to pay them to avoid upsetting investors and protect their share price, putting in jeopardy the future financial situation of the business. As mentioned before, some other companies, even if they have a good dividend yield, just the fact they're paying dividends could disappoint investors. And the best example I can give you are small companies in the tech sector. This is a constantly changing environment where you need to innovate, and this innovation might be expensive. So investors will be more comfortable in this case if a dividend is not paid at all, and the company focuses on reinvesting their profits to promote their stock price instead. Companies like Coca-Cola, for example, they already have a product that people love, and there's not really a lot of innovation you can do in that sector. If you take a look at their chart, their stock is very linear, and the price hasn't changed much in the past 5 years. So, since the company cannot provide significant returns to their investors through their share price, they make up for with dividend payments. And this is something that also happens to manufacturers, as opposed to Nvidia, for example, which is part of the technological sector. And you can see in their chart, the price has had a lot more volatility within the same time frame. So a dividend payment from a company like Coca-Cola that is very mature and most importantly has been paying out a dividend for over 50 years is perceived as a good thing or as an extra benefit by investors. So before you invest in a company that pays dividends, make sure it's in a good financial position to do so. A huge debt and a dividend payout is not really a good combination. Also, make sure that they have a good dividend yield, but most importantly, what they do as a company, how long they have been in their sector, and which sector it is to see if it actually makes sense they're paying one. You can also review the historical dividend payouts of the company. And what you want to see here is how long they have been compensating their shareholders with dividends. Of course, the longer and the more constant they have been without interruptions or suspensions, the more reliable it is. On the other hand, if they have just started paying dividends recently, let's say in the past 5 years, for example, or they have been for several years, but it's not very stable and it goes from a higher to a lower number each year, or has been suspended and reactivated several times, these businesses will of course represent a higher risk.